As most of the US deals with hot temperatures, inflation is cooling to its lowest level since March 2021. The latest inflation data is like a breath of fresh air for shoppers who have witnessed their purchasing power decline and their budgets strained by steep price increases over the past 2 years. According to data, consumer prices rose 3% in the year to June, down from May's 4% gain. Inflation has sharply declined from a peak of over 9% that consumers faced last summer. The latest reading represents the slowest pace since March 2021. President Joe Biden attributed the positive inflation news to his economic policies in a statement, referring to it as Bidenomics.
Good jobs and lower costs. That's Bidenomics in action. Today's report brings new and encouraging evidence that inflation is falling while our economy remains strong. We've made this progress while unemployment remains near record lows and a higher share of working-age Americans are in jobs now than in 20 years.
The much better than expected numbers could give the Fed some breathing room, considering that its hands are already tied due to GDP growth slowing down to 1.4%. As a result of global economic landscape and slower export growth. These developments also coincide with China trade and chip wars, which have adversely affected the US economy and pushed China towards the brink of deflation. Now both China and the US are attempting to repair economic ties.
The US and China have significant disagreements. Those disagreements need to be communicated clearly and directly. But President Biden and I do not see the relationship between the US and China through the frame of great power conflict. We believe that the world is big enough for both of our countries to thrive.
China's consumer price index showed no growth in April, in sharp contrast to the US, where inflation still remained well above the Fed's target of 2%. This fire and ice situation complicates an already fragile global economic recovery that is further affected by trade tensions between the two superpowers. Tulay Kalyon Haznedaroglu, TRT World.
Well, let's get more on this now with Mickey Levy. He's Berenberg Capital Markets Chief Economist for the US and Asia. Good to have you back with us, Mickey. Let's start with the US. After about a year of interest rate hikes, inflation is now down to 3%, but the US Federal Reserve has said in the past it wants inflation to go down to around 2%. So does that mean we can expect more interest rate hikes from the US Fed in the near future?
Likely one more hike the end of this month, the scheduled meeting in July. But then they'll pause. The next meeting is September. So yes, inflation has begun to come down. But it's the headline inflation that's come down significantly, while the core inflation, excluding food and energy, remains sticky and high. That'll come down gradually, but it's a real dilemma for the Fed. Because inflation is going to stay way above its 2% target, and it's a real nagging issue. How much further should the Fed hike rates in order to push inflation down, or should it? Some members of the Fed would like to take its foot off the brake a bit. So it's really an interesting situation, but we're going to get one more hike at the end of this month.
Can I ask you about China now? Because it's having the opposite problem to much of the rest of the world, because prices there are falling too much and too quickly. Why is that bad for the Chinese economy, and how could it impact the rest of the world?
Well, China's economy is very, very weak, and this is what is generating the decline in prices, particularly in prices of real estate. And keep in mind, the excesses that were generated by the government in real estate that have now collapsed. It's going to take a long time to clear up those excesses, and as housing prices fall, that is hitting household net worth, which is reducing the propensity to spend. So China's weakness, lower inflation, is a direct reflection of its distinct economic weakness. And it's that weakness that is affecting global economies and global trade. So this is for the second biggest economy in the world to be really faltering it is a significant issue. And I would also note that they will try to stimulate the economy, but they have limited flexibility to do so, and I don't expect the stimulus to have much more than a temporary impact.